Welcome, Jordan. Let me introduce Jordan Levine from C.A.R. Jordan Levine is the Deputy Chief Economist at the California Association of Realtors. I didn't know that. We have more than 190,000 members now in California. I think that's about half of all licensed agents in the state are realtors, so that's great. Jordan helps oversee all the housing market research at C.A.R., including the market statistics, survey research, industry trends, policy analysis for C.A.R.'s legislative and government affairs efforts. Jordan has a bachelor's degree in economics from University of California, Santa Barbara, master's degree from international economics from the University of Sussex. Prior to joining C.A.R., Jordan worked in consulting as an economist and director of economic research, where he oversaw all research and economic analysis on California's economy and housing market. And he regularly speaks to trade groups, public officials, businesses, and the media. We're very pleased to have you, Jordan, with us. Thank you for taking the time and joining our small group this morning. Jordan, it's all yours. Welcome.
Oh my gosh, Dirk and Danny, thank you so much for having me here. I'm going to try and share my screen so that you can look at my slides and not my face, and see if I can't make that work so that I can go through. Oh, Danny, you mind making me host? Because I promise you it'll be better if we look at charts than this coronavirus beard that I'm going
Yeah,
with
go ahead,
today.
try again.
But yeah, I'm glad to be here. I actually used to be right down the street. I'm a housing refugee from LA, but I used to be located right there on Hawthorne and Del Amo, so I know the South Bay very well. Here's my slides, and this is our market update. And actually, a lot of this stuff is kind of fresh off the press. We run a weekly realtor survey, which just closed out last night, or Monday night rather, and we got the charts yesterday morning, and we also have updated MLS data right through that week of 4th of July. So I'm excited to walk you through what's been going on. I think for better or worse, there's both good and bad news at this point in time. I think we've seen, on the good news side, there's been a lot of progress, right? When you look at the economic data, which is, albeit inherently kind of backward looking, we've seen, a lot of different aspects or areas of that macro environment showing signs that things are starting to heal. We see interest rates, and I just locked in a refi, and I'm back here hat in hand because I think at this time last year I was saying the days of 3.5% rates were behind us. I don't feel too guilty that I wasn't able to foresee a coronavirus, but be that as it may, we're in an environment where rates are at all-time low levels, and I'm sitting here today talking to you as the son of a guy who used to walk around bragging about his 13% mortgage interest rate back in the early 80s with all of his buddies. And so it's truly historic, what a wind in the sails that will be for housing. And indeed, we see it when you look at buyer demand, right? The various measures of buyer demand, be it, showing appointments or mortgage applications, or even sales themselves. We see that the numbers have all moved in the right direction, which brings me to my next point, that the market data is showing signs of improvement. In fact, as I'll show you, we're largely back to or above pre-crisis levels from a closed sales standpoint, finally. And so we see that in our business, in our survey of realtors. Realtors are reporting that increased optimism and positive things happening in their business. And we also see it in our consumer survey data, where we talk directly to Californians and ask them, is it, things like, is it a good time to buy? Is it a good time to sell? What do you think is happening with home prices? And so all of these areas we see improvements and indeed signs to be optimistic about. I wish I could just kind of go ahead and cut off the presentation there and we'd all go out and crush it and close a bunch of transactions this week. But I do want to, I'd be doing you a disservice, I think, if I didn't point out that, we've got a long road to hoe on this thing. When you look at the economy, although things are moving in the right direction, we have a big hole to climb out of, shall we say, right? There's been lots of damage done by this downturn. And so even as things have started to move in the right direction economically, we still have a long road ahead of us, and a lot of healing left to be done. In addition, and I didn't bring this, but we were joking internally because C.A.R. just released its kind of guide to reopening the office. We're all still working remote, but there will be up to 25% of us going back to the office at some point in time. But just going through that document about how to reopen the office and all of this stuff made me very glad I'm in research personally and not in the operations department of C.A.R. because just all of the considerations, I was really, I guess I shouldn't have been shocked because of all the protocols and things that we already know about in our daily life and things like that. But just putting it all down on paper for a business and just all of the hoops and protocols you have to follow shows that we still have a big learning curve ahead of us, and those guidelines are going to be getting tinkered with and tweaked and refined as we go along. And so there's, in addition to just having a big hole to climb out of, there's a steep learning curve that we're all going to be kind of grappling with as we move forward. The other thing is that kind of the blessing of an economy and a market that's starting to recover and buyer demand that's starting to come back is also in some ways a curse, because it's caused this kind of age-old problem of not having enough housing inventory out there to rear its ugly head again, right? So we're actually now that we kind of have the worst of the crisis in the rearview mirror, hopefully, a supply problem again, where there's more buyers who want to take advantage of these low rates that my dad would have killed for, but not enough homes to be able to put those folks into. And so as a result, we are already seeing part of the rebound that we've enjoyed for the last month and a half or two start to slow. And in addition, the numbers on COVID and the uncertainty about what the future looks like is starting to really ramp up, right? The case numbers look pretty ugly. And so, it's causing us to go back and look at our forecasts and some of the less rosy scenarios that we had considered if we weren't able to just continue to get better from here on out, and God forbid have to re-shelter in place or things like that again moving forward. So let's start though with the good news, because there's plenty of signs that the worst of the crisis had been behind us, and that we were in fact moving in the right direction. First and foremost is on the unemployment side, right? So we had gone from a period in time where we were adding basically only about 280 or 210,000 folks to the unemployment rolls, to a point in time where we added about 6.9 million people to the unemployment roll just that very last week of March, which was an all-time high level. But actually, we've had 13 weeks in a row where the number of folks going on to unemployment has been declining. And so as of the week before the holiday, and we'll get new numbers tomorrow for 4th of July week, we see that we're down below 1.5 million in terms of folks that actually filed for unemployment last week or 2 weeks ago. In addition, we just got last Friday the unemployment numbers for the U.S. as a whole, and we actually had a bigger decline in unemployment than what we had been expecting. So we were up in the 15% range prior, and dipped all the way down to 11.1%. And so you could see that some folks, as that economy started to reopen, definitely were hired back onto those roles. In fact, if you look at the non-farm side, two separate surveys. So in some ways we're looking at apples and oranges, but they both generally trend in the same direction. And what you can see is that, yes, we had the biggest decline in non-farm employment in recorded history, lost 20.8 million jobs in April, added back 2.7 million of those jobs in May, and another 4.8 million jobs in June. And so, we're still, tens of millions of jobs below where we were at the crisis, but adding back almost 8 million of those, 20 million jobs is nothing to sneeze at, and does show that we've had 2 months in a row where things have gotten better. And again, we're talking about orders of magnitude that are in the millions, right? And so these are all positive signs. We talk about how the labor market is the single largest driver of the housing market, right? That's why I'm kind of nerding out with you on all these esoteric economic indicators, is because when people are working, when they're earning income, when they're back to work, when they're not on furlough, when their hours aren't being reduced, then they have more money to put into things like home ownership or trading up to a bigger home as work from home space, or all of these different things that we're seeing happen in the marketplace. Even commuting, no longer having to commute and wanting to get a bigger house, maybe in a bit farther out of an area. And lo and behold, we do see that actually the consumer side of the equation started to follow suit on the jobs numbers, right? So that good news is that kind of Econ 101 is still intact, right? And as people got back to work, that we did see them go out there and start spending money again. We're still about a 70% consumer-driven economy. About 70% of our GDP is due to consumption. And if you look at overall retail, I think we were still down about 7% or so in May, but we were very close once you strip out car sales to those pre-crisis levels. So consumers have definitely come back. We actually saw consumer confidence come back in June. We've still got a long way to go to get back to pre-crisis levels there, but after falling to or experiencing our single largest drop in recorded history, we have for 2 months in a row started to claw some of that consumer confidence back. And indeed, when you look at the growth rates for those retail sales, we had a pretty strong bounce back on the consumer side. A little closer to home, when you look at housing in particular, housing has one thing going for it in a major way, in addition to just the fact that we've spent many months all cooped up in our homes and realizing that we need work from home space and all of that stuff, is that mortgage rates are, again, as I said, at all-time lows. And the reason why that matters is because if you look at the dark blue line on this chart, what you can see is that we did get some price softening in June in the statewide median price, which was down about 3.7% compared to where it was at this time in 2019. But this has actually been, so we got some, kind of boost to affordability just on the basis of prices alone. But once you bake in this reduction in rates where we've fallen, and keep in mind that at the beginning of 2019, we were almost at 5% interest rates, right? And so rates were already coming down in 2019, but have really come down in 2020. And so when you put those lower rates together with lower prices, and you work out not what the price of the home is, but what the cost to consumers is in terms of their monthly mortgage payment, that number is actually 13% lower than it was at this time last year, right? And so, and actually, if you look back at this light blue line here, you can see that we were actually already down about 5 or 6% last year, because we had fallen from about 5% down to 4%, right? And so when you put that all together over the last couple of years, you basically have a 20% savings on a monthly mortgage payment on that median priced home compared to what you would have spent at 4 or 5% interest rates. And so for those, we always get asked this in real estate: is it a good time to buy a home? Is it a good time to sell a home? And people are going to point at, unemployment and all these macro factors and the fact that we're in a global pandemic and forecasts have been reduced. But for those of your buyers who still have a job, who work at a place like C.A.R. where, we haven't seen a lot of drastic cuts to our workforce, or in the tech sector, which also has been relatively unimpacted. There's really been 5 major sectors that have been impacted. For buyers who are still earning money and confident in their jobs, this is real savings. And in places like the South Bay, where the median price is in excess of $700,000 or more, depending on the market, 10 and 20% savings on your monthly mortgage payment really adds up to real dollars and cents that make it a pretty good time to get into the market from a long run perspective, right? Over the course of 30 years, that adds up to a lot of savings. And so that's one of the critical things. And in fact, when you look at mortgage applications, the demand is responding, right? In fact, if you look at last week during the midst of a holiday 4-day week, right, where everybody had Friday off, we had 30+% more new purchase. So I've stripped out refis. Forget about refis. This is just purchase applications were 30% higher than they were at this time last year, even in the midst of a pandemic, right? And so I think that this just shows how much affordability really matters, right? And how much of a again a wind in the sails of housing 3% mortgage interest rates will be. And indeed, when you look at the showing numbers from showingtime.com, again, this is another way to gauge that buyer demand. But we see that actually, we're still about 25% above where we were at the beginning of the year, after being something on the order of about 40 to 60% below back in mid-April, right? And so you can see that as the kind of worst of the crisis got realized, or the uncertainty or the fog started to lift and rates really came down, we see that buyers really wanted to get out there, in part because, folks are spending, again, a lot more time in their homes. They're not having to commute. They've, been freed of the requirement to potentially locate in the less affordable, less available markets close to their job. And lo and behold, you see that is all culminating in not just a resurgence in requests to see homes by buyers, right, which is what I'm showing you here, but actually if you compare it to the green line for 2019, again, we're not just recovered relative to where we were before the crisis, we're actually ahead of the game compared to where we were even in 2019 from an interest standpoint from buyers, right? So these are all positive signs, and they're all positive signs that you all are reporting feeling in your business, right? So when we asked in our weekly survey, and again, this just closed on Monday, did you do any listing appointments this week? You can see that these numbers continue to trend up. And in fact, again, even in the midst of a holiday week, we still had 1 out of 3 realtors that we talked to over the weekend that actually did a listing appointment. And those numbers have been trending upward pretty consistently. Similarly, when we asked if those actually turned into listings, again, I was relatively surprised yesterday to see that we had an increase in the number of folks who actually listed a property last week. 1 out of 4, a little bit better than 1 out of 4 realtors that we talked to last week actually had one of those listing appointments result in a listing, right? When we asked if you entered escrow, here's a fairly clear trend. Week after week, running right through the weekend, our highest number in the last couple of months, 32% of realtors actually entered the escrow process last week. If we're seeing basically low and stable numbers around falling out. Those were up in the teens previously during the height of the crisis, and fairly stable at about 5 or 6% of transactions only falling out, which isn't that elevated relative to normal. And the numbers here are especially encouraging, right? Realtors are making more money. Did you close a transaction last week? And we see that those numbers, outside of a blip in late June, have largely been moving in the right direction, with 26% of realtors that we spoke to over the weekend actually closing a sale, right? And so we see it in the economic data. We see it in the the signs of buyer demand that we observe out there. And in fact, we're actually seeing it in the marketplace itself. If you look at our press release, which we put out for May, and we'll have our June press release covering the June data coming out in a month, the numbers were pretty ugly. And I would argue that May bore the full brunt of coronavirus. The shelter in place happened about March, which really impacted pending sales for March and April. And that is where we saw these big declines of about 41% on a year-to-year basis in closed sales that brought us down about 13% below where we were through the first 5 months of 2019 in terms of transactions. Closed sale prices, I mentioned, were also down about 3.7%, fairly modest given the scope of the pullback in home sales, but we'll get into that in a minute. We did see unsold inventory index increase from about the 3-month range up to the 4.3-month range. I meant to put an asterisk on this because I don't want you to over interpret that. That's a statistical anomaly that we'll talk about in a second. But in fact, if you look at even under the hood of the May numbers, you could see that that was, again, really the result of weak pending sales in March and April. And if you actually look at the properties that went pending in May, we had a huge jump in the number of homes that went pending. We see that the trough for demand was basically that second week of April. And since then, we've really seen, as I showed you in the mortgage applications on the showing time, the buyers have really wanted to take advantage of these low rates. And we see that in the pending sales numbers for May, which suggests that, we're not going to see this kind of ongoing 40% decline that we saw in May for close, that things are actually going to start moving in the right direction. In fact, I can be confident in telling you that because we're actually going into the MLSs across the state every single day and then rolling these up into weekly aggregates for closed sales. And you could see that actually we have been above the pre-crisis level of closed transactions for the last basically 4 weeks in a row. And we had our largest numbers last week, again, during the midst of a holiday week. We were still closing on average 800 transactions a day across the state. And that shows a pretty clear trend of improvement that started basically back at the, early part or middle part of June. When you look at it in terms of Southern California specifically, which I know is what we all care about in this room, in some ways I almost didn't even need to bring the Southern California breakouts, right? Because we're seeing a very similar trend in LA, Orange County, and the Inland Empire in particular. I think we're seeing a lot of first-time buyers want to take advantage and don't have to necessarily commute into downtown LA or things like that anymore, and that's really benefiting the Inland Empire. But you're seeing it across the board in San Diego, LA, Orange, what have you, even in Ventura, which has actually been in a recession even before COVID-19. You're seeing those closed sales numbers back to crisis levels or higher, where they've been for the better part of the last month. So that's the good news. And the other good news is that we really haven't seen much impact to prices. I know we reported a median decline or a decline in the median price. Part of that was due to the mix of sales, right? The top end of the market took a bigger beating than the bottom end of the market. In fact, if you look at it on a per square foot basis, both in terms of list prices, which I'm showing you on the left-hand side here, or closed sale prices, which I'm showing you on the right-hand side, on a per square foot basis in Southern California, we actually have listing prices that are higher than they were even in that first week of March before we were ever even sheltering in place. And on the right-hand side, even when you take into consideration all the negotiating and wrangling that goes on during the closing or the escrow process, you can see that's fairly stable numbers on the per square foot closed sale price in Southern California. And indeed, if you look at just ask a very basic question, we go into the MLS every day and just ask, for each listing on there, is it discounted or is it at the original list price? And what you can see is that there was actually a smaller percentage of listings of actives, on the left-hand side here, that were discounted than there were even, again, that first week of the shelter in place. And similarly for closed sales, right? We actually have not a big increase in the percentage of closings that are closing with a discount. We're at that same kind of 50%-ish level that we were at pre-COVID-19. So not a lot of impact to prices. And I think that is the good news, right? When you look at all of the economic data, it started to improve. We see that that's showing up in terms of actual buyer demand. And I think that definitely those low rates are helping. And we see that that's playing itself out across the closed sale process and also preventing prices from dropping pretty significantly, right? So that is all stuff that bodes well for us as individual real estate professionals. We know people want to buy homes and that their economic situation is improving. The bad news is that we've got a big hole to climb out of, right? So I showed you how we had added back, I think it was something on the order of about 2.5 and then 4.8 million jobs over the last couple of months, which is great. And you could see that kind of check mark shaped rebound there at the tail end of this chart, which shows us total non-farm employment in the US. But what that also shows you is that we've still got a lot of lost ground to make up on the employment front, even again as things move in the right direction. And the other thing is, even though we're not seeing more and more people file for unemployment, I showed you new claims, which are the number of people who just lost their job that week and were filing for unemployment. Those numbers are going down, but when you look at ongoing claims, which includes the people who filed that week, as well as everybody else who's still trying to get money from the government as being unemployed, those numbers remain relatively elevated, and they've come down from about 25 million people on the dole to about 19.3 million. But again, we're still talking about 19 million people who are on the government take right now, compared to something on the order of about 1.5 or so million that we had before the crisis, right? And so even as things start to get better, we've still got a lot of folks out there who are struggling, and that's going to take a while to chip away at that, right? And so we're improving, but we've got a long way to go. And the same thing is true here in California specifically. We've still got almost 3 million people still on unemployment, down from almost 5 million people, again, back in late April. But again, 3 million people, still facing economic challenges. And the other thing is, here in California, what we've seen is that actually the number of new unemployment claims has actually been rising for the last month. So we're up to about 280,000 folks 2 weeks ago filed for unemployment. That's actually almost as high as what the nationwide number of unemployment claims was pre-COVID-19. And so we've still got a long way to go. And with these cases rearing their ugly head, we've got potentially more increases in unemployment that we're going to have to grapple with. And so things have gotten a lot better, and we've made a lot of progress. But again, we don't want to over celebrate or crack the champagne corks, especially when you look at pendings, right? I showed you how closed sales were back to pre-recession peaks, but we're seeing the momentum in pendings start to peter out as we get towards the tail end of the kind of home buying season. And we've had 2 weeks in a row with fewer homes going pending on a weekly basis than we had after basically 2 months of pretty solid growth here in California. And you see that same story playing itself out across Southern California, that we are indeed approaching the end of the home buying season. There was a lot of questions out there about whether, the home buying season was going to change and we were going to continue to extend this out into October and November or something because of all this pent-up demand, and we've been stuck in our homes. But indeed, it looks like things are following that same kind of seasonal pattern here in Southern California. And on top of that, the supply issues are going to mute the recovery as well, right? And that's going to become a bigger issue. So active listings were down by 34%, in May compared to where they were in May of 2019. And so even as buyer demand starts to come back, if there aren't homes out there to get these buyers into, then we don't see that growth in pending sales and closed transactions. And indeed, when you look at the numbers for Southern California, that's a huge drop, right? We had almost 30,000 homes on the market at this time last year, and now we have less than 18,000 homes to sell people across Southern California. So even as things get better, again, you can't create transactions out of thin air if there aren't homes out there available to get these buyers into. And this is why I said don't get fooled by the increase in unsold inventory, which went up from about 3 months of supply to about 4 months of supply, or 4.3 months of supply. That was just because sales bore the brunt of coronavirus in May. And so we had a bigger decline in sales than we had in active listings. But actually what we see in the pendings is that we're not going to see those big declines in sales moving forward, but we still have these declines in inventory. And so unsold inventory should start to snap right back as the sales try to come back. And again, the listings aren't there for those buyers. And indeed, when you look at the number of homes that are being added to the MLS every day in California, those numbers have been falling for the last month, right? They're not falling by a lot, but we aren't continuing to add new inventory to replenish these sales that we're trying to make. And so again, the inventory story is going to be starting to dominate again in the way that it was in 2016 and 17 when there just wasn't the homes to get buyers into. And again, you can see that's true here, even through last week right here in Southern California. The other thing is, COVID is rearing its ugly head again as well. And California has certainly seen a spike in cases. I'm not a medical expert, but I will just say that this has economic ramifications, right? Because a lot of our forecasts where we had baked in basically an improvement from the end of May onward and the economy gradually reopening, this seems to suggest that scenario is going to face challenges coming to fruition, frankly, right? Because we're seeing COVID ramp back up. There's a lot more people in the hospital now than there was, and we're seeing actually the percentage of people testing positive increasing. So it's not just the numbers going up, but the percentage, which suggests that it's spreading faster, right? And so, you can see that here, that the daily average of testing, it's almost 7% of the people getting tested are testing positive, which suggests that, again, we've got a long row to hoe in terms of the virus itself. And indeed, when you look at our realtor survey, one of the less optimistic signs, most of them were optimistic, and I shared those with you, but if you look on the right-hand side of this, you can see there was actually fewer buyers wanting to withdraw an offer. Buyers are still fairly gung-ho, but on the right-hand side, we've actually had a couple of weeks in a row now through, and again, this is timely as of over the weekend, so this kind of incorporates, people know about the spike in cases basically is baked into these last couple of weeks of numbers, that you do see more sellers starting to pull their homes down off the market, right? And so that's the wild card that really stands to upset all of this good progress that we've made over the course of the last couple of months. And indeed, I would argue that we might even see this start to bite into buyer demand as well, right? And so what I'm showing you here is that same showing times data, the schedulings for private showings. And what you can see is that there's a pretty strong correlation between the ramp up in new COVID cases that we had back in March and April and the severe decline in requests to see properties, right? And we haven't seen that yet. In fact, if you look at the right-hand side of this chart, the yellow line is still higher than the green line, right? We still have more people requesting showings right now than we had at this time last year. But you can also see underlying that, or behind that, the huge spike in cases, which suggests that we might see this show up on the demand side, just as we've already seen it start to show up on the supply side, right? And so, and the other thing I would say is that showing time data does suggest that we're not seeing this big extension of the home buying season. We're higher than we were at this time last year, but you do see that the decline in just demand for showings is following that normal seasonal pattern, and buyer demand does start to taper off as we get towards the tail end of summer. So I do think we've answered that question about whether the 2020 home buying season extends through November, and I think the answer there is unfortunately no. And so if you put it all together, the outlook is that, most of the economic damage has already been suffered. The vast majority of the declines to GDP, regardless of what forecasters you ask, expect a 30 to 40% decline for GDP during the second quarter, with a fairly robust bounce back of, at a minimum 8% all the way up to 25, 30%, depending on who you ask, in the third quarter and beyond. Our baseline scenario for closed sales was that, the similar thing was true, that we bore the brunt of COVID in May, and that we would see smaller and smaller declines on a year-to-year basis moving forward as we start to claw back some of that lost activity. And similarly, that modest price softness that we saw would persist through the end of the year, but really only in that kind of low to mid single digit range. That being said, there's, a lot of question marks out there. And so if I had to put a bow on all of this, and I wanted to leave some time in case you guys had questions, or if we just wanted to chat or have a discussion or whatever, I would say that yes, things have gotten better. We see a lot of improvement, broad-based across a number of economic indicators, right? I showed you all that macro stuff at the beginning, because I want to justify these student loans, that it's it took me about 17 years to finally get paid off and just kind of do all of that stuff. But also because it really is broad based, and that goes to what happens in the housing market, right? When people are working, when their businesses are making money, when rates are low, when people are applying for mortgages, asking to see properties, spending money at retail stores, taking their families out to eat or what have you, those are generally good signs for the housing market. That being said, I think it's way too early to celebrate, and I hope that you didn't go out during the first half of my remarks and grab your best bottle of champagne and make yourself a beautiful mimosa, because I do think that we've seen the rebound that we've enjoyed over, frankly, the last couple of months pretty consistently starting to really lose steam, right? And I showed you that in terms of the declines in folks filing for unemployment. We've made a lot of progress, but that has started to stall out. We've seen pending sales really start to again languish, right? Because the big issue is on the supply side, and there just isn't the homes out there to be able to put people into. People are worried about having buyers going through their homes, right? There's still that kind of behavioral aspect to it. There's people who have a lot of psychological scar tissue and don't want to sell a home during a recession, right? Because they remember 2008, you sold your house in 2008, you took a 30% haircut, and they don't want to do that. And so I think that again, supply is going to start to rise to the fore as one of the big issues that holds back the recovery. And the other one being the wild card of COVID, which looks like it is, going to be with us for a lot longer, unfortunately, moving forward. And so just to keep it really real, I would say that there's still tremendous damage that we need to repair in our economy, even as we are doing that good work of clawing back in terms of jobs and retail sales and et cetera, et cetera, et cetera. There's, a long way to go, and we've got a lot of clawing left to do. Shall we say. And the other thing is with the case numbers, and again, I'm not a medical expert, and that's why we have actually scenarios for our forecast instead of just one specific number, as we have been doing for the past 30 years. There's just so much uncertainty, but we're starting to look at our baseline scenario as potentially a best case if we have to shelter in place or close the economy back down to start to grapple with this virus again. And so I think for me, the one-liner is that we can be more optimistic about the economy, about the housing market, but we need to be very cautiously optimistic and to really keep an eye on those case numbers and to do our part to be safe and operate safely and get people into homes, but do it in a safe way so that we can truly get this thing in the rearview mirror. So with that, I will say thank you so much to Durf and to Danny for having me here with you today. And if I didn't beat you all into submission, or if we have the time or whatever, I'm happy to answer any questions that y'all might have.
Jordan, thank you very much. Raise your hand, give us a chat. If you have
and I see one question, if I could, that these charts are actually all going to be on the C.A.R. website after this. And the other thing I'll do is I'll email them as soon as I jump off here to Danny, so that you guys just have them if you need these or want to share them with clients or whatever.
Thank you. Yeah, I think it's great information. In fact, I hope our the payment of our the C.A.R. dues over the years help pay off those student loans for you, because it's well received. Thank you.
I owe it all to C.A.R.
I always say that 20% of our agents do 80% of the business out here. And this is an example. We have over 250 agents in our company. We get less than 40 participants in our meetings here. So there's really, as I tell my students, I go, there's no competition out there for those that really want to work out there. So this is a good sign. This material is excellent for buyers, for those that, especially the engineer, nerdy type buyers that you have. This is stuff that they would love to look at, and it is available on the C.A.R. website. Any questions before we say bye here to Jordan?
Hi there, I have a question. First of all, I loved it. Thank you so much. I can't wait to watch it again. This is slightly off topic, but I think you can help us out. They're saying because of all of the payments, due to, the high unemployment, that it is inevitable that in 3 to 5 years, we are going to have inflation. And I'm not that familiar with inflation. I'm 45. I was trying to think of an era of where I even lived during an inflation. I just wanted to know your opinion on that. They're saying that because there's so much money in the, being pushed. However, because of COVID, it's not being spent right now, and that we should see that in 3 to 5 years, and that it will definitely cause an inflation.
Yeah, so those people who are telling you that are definitely very well versed in Econ 101. When I took macroeconomics as an undergraduate in college, that was definitely the story. And you had government spending or budget deficits, huge national debts that tended to generate significant amounts of inflation, a la kind of the late 70s, early 80s, which was the reason, frankly, why we had those 17 and 18% interest rates that my dad used to brag to his buddies about. But the reason why I don't think that I think there's a couple links of that chain of the Econ 101 story chain missing there to generate the type of 1970s inflation that we can expect. I am no fan of, and I'm certainly not here to defend government budget deficits or debt, national debt accumulation. But the reason why I don't think it's going to be as inflationary, if you look at the quantitative easing side, right? The Fed this time and in 2008 pumped tremendous amounts of liquidity into the system through quantitative easing. But actually, and I didn't bring this chart with me today, but if you break down the net monetary base, which is basically the money that the Federal Reserve puts into our financial system, and you break it down into what they call kind of M2, which is like money that's out in circulation, yours and my bank accounts that we go out there and actually spend, and how much is sitting in the virtual bank vaults. They're not vaults anymore, they're just computers. But how much is actually out there as just excess reserves. The vast majority of the stimulus that the government pumped in on the Federal Reserve side, the monetary stimulus, sat there as a backstop for the banking system. It all went into excess reserves. It did not turn into the types of loans, business loans, credit card loans, auto loans that really are needed to generate inflation. When we talk about inflation, that's the econ nerds way of saying higher prices. And where higher prices come from, and the reason why Econ 101 tells us that so much stimulus, either fiscal or monetary, is inflationary, is because it overheats the economy. All these people have low cost loans, right? Money burning a hole in their pocket, and they can go out and bid up the cost of cars and groceries and clothes because they are so flush with this cash that the government has pumped in. That didn't happen last time around, and it hasn't happened this time around. This stimulus is purely about backstopping the banking system, not about putting money into the hands of individuals out on the street that are going to go push up the cost of milk. That's point number one. The other point there is even on the fiscal side, and we do have a big national debt, and I know we're probably putting everybody here to sleep going into such crazy nerd territory, but with the fiscal deficit and debt stuff, the one thing you have to keep in mind there is that traditional theory would say that the bond market would come and demand their pound of flesh, right? They're either going to see it through, that the Fed's either going to try and inflate away the debt, and people are going to know that, and therefore demand more returns or cheaper bond prices in order to loan the U.S. government money. The reason why we've been able to get away with all of this debt and deficit for so long is that, for all of our warts and problems that we have here in the U.S., we always kind of describe the U.S. economy in the research department at C.A.R. as like the cleanest dirty shirt in the hamper, right? Is that we've got lots of problems, but the rest of the world has even more problems. And so the U.S. is still a kind of safe haven for everybody else's money in the rest of the world. And so, returns aren't the big goal of buying a U.S. government bond for somebody who lives in a place like Brazil. Right? You're there to hedge against issues in your own country. If the U.S. government bond pays you 2%, that's great. That's just a bonus. But really what you care about is preventing against losing all your money when your foreign currency depreciates by 20% or something like that. Right? And so as long as the U.S. government bond remains that safe haven for global capital flows around the world, you're not going to see these people really come for that pound of flesh because of our debt and deficit. And that's something I think that takes much longer than 3 to 5 years to get back to the original question to unwind. Yes, if we got to a position where we were all borrowing in yuan, or the oil was being traded in yuan, or whatever the Russian currency is these days, then but that's something that's talking about a whole unwinding of a whole global economic order, and that takes again a lot longer than 3 to 5 years.
Jordan, thank you. We got a couple other questions here. One of our agents, Dan Pilson, he's going to put you on the spot here. He goes, will prices go up or down in the next 6 months?
Yes.
Yes.
No, we're not expecting big movements in prices. We do think that we will probably end the year, something in about low single-digit percentage below where we ended 2019 in terms of median price, partly because the top end of the market has been more impacted by COVID than the bottom end of the market. But actually on a per square foot basis, we're not expecting big movements on prices. We're not expecting a big increase, but definitely nothing on the order that some buyers out there are expecting. Again, thinking back to that psychological scar tissue from 2008, some buyers see a recession and they go, oh my gosh, I'm going to save 200 grand on a house now. Right. And unfortunately, we just have or fortunately or unfortunately, depending on which side of that equation you're sitting on, we just don't have the fundamental problems in our economy that we had back in 2008 with all the 5-1 option arms, all the negative amortization stuff, all the zero down ninja loan type stuff, the no income, no job or asset lending just didn't happen this time around. Everybody had skin in the game. Everybody's got a fixed rate mortgage. In fact, I would argue not enough people were able to get into housing this cycle and take advantage of all these low rates. And so for that reason, it's not to say that a recession doesn't hurt, and we are forecasting about a 3% decline in home prices, but we don't have all that underlying imbalances that are going to start to snowball because of this recession and lead to that kind of 40 and 50% price declines that we had last time around.
Thank you, Jordan. So is that the same answer then for this next one? Are you expecting foreclosures or short sales due to COVID?
That one is harder to answer. I had not been expecting a big ramp up in foreclosures because the government really, I think, learned an important lesson from 2008, which is essentially pay now or pay later, right? That they didn't end up doing themselves any favors by saying you're all on your own and whatever happens. We all ended up taking that on the chin with a much more severe recession. It probably would have been much cheaper to keep most of those people in their homes through deferments or things like that. And so it does seem like learned our lesson in terms of working with homeowners to keep them in their homes and things like that with the forbearance. And more importantly than the forbearance is the workout option on the back end, that you don't just have like a 7-month balloon payment at the end of these deferments. That being said, we can't let them defer forever, right? And so, the reason why I hadn't been is that, you get 6 months of a break on your mortgage payment, and then COVID's behind us. We get back to work, and you can start chipping away for 5 years at that's those missed payments or whatever. But if it goes on through the end of the year or into 2021, and and the recovery is stalled out as a result, there's a limit, I think, to how much the government's going to be able to do to keep people in their homes, and then we might see foreclosures. I don't think it's going to look like 2008, but I do think that the likelihood of seeing foreclosures has gone up as the second wave of COVID has reared its ugly head.
Thank you, Jordan. Any other questions, comments? Okay, I'm going to let you get back to work, Jordan. I really appreciate your time today, and hopefully you can join us again. Thank you.
Thank you all so much for having me.